Hello, folks. Brandon Chapman with you for Monday video for TheoTRADE. It's what's a Monday? It's November 13th, 2023, and what a day it is. What an exceptional day it is. In fact, if we look at the S&P 500, the ES futures basically unched on the session. We look at bonds. We'll take a look at /ZB here. Basically unched on the session. We have a scenario where bonds and equities are basically unchanged as a lot of data looms this week. So for example, let's take a look at a calendar. Some Forex factor. We've got CPI data tomorrow. We've got PPI data, retail sales, Empire State Manufacturing. And again, unemployment claims we get every week on Thursdays. So the point is we got some big data out this week that could really move the market and specifically could really move the bond market. So for example, also we have not a debt ceiling, but we have a budgetary potential shutdown coming up in 4 days. We've got 1 week to pass some sort of continuing resolution. Right now, the Republicans or the House speakers talking about a laddered approach where some aspects, some of the 12 areas of government are funded up until one date. The rest of them are funded till another date. We'll see if there's any traction. Obviously, the Democrats want just a clean continuing resolution with all the goodies, and something will probably carry them towards the end of the year. And then we get some sort of like Christmas spending spree, just like we get every year with the continuing resolution that might go longer. So point being is that there is some risk out there that could move the market. So while today we are unched on the equity and on the bond market, we're unlikely to finish that way by the end of the week. As we look at the ES right now, you'll see that we're testing recent highs going back to October 12th. This makes sense that this could be a key inflection point for equities, but don't take off the table the possibility we may continue to run. So one of the things that I like to look at is the VIX 3 VIX ratio. And what this means is we're looking at the structure of volatility. Notice today how the yellow line ticked down. What that means is that the ES is now, the 3-month VIX is only about 12% higher than the 30-day VIX. And so if we see a nice little buying spree this week, maybe tomorrow the inflation data comes in less than expected, bonds rally, we see a push higher in stocks, this could readily push up into this danger zone north of 1.2, which means the 3-month VIX is 20% higher than the spot VIX. That's one possible scenario. Another possible scenario is we start to see the market drift in lieu of potentially higher inflation. Now, as we look at /CL, we're looking at oil prices right now. Let me just try to bring it up here. What you'll see is oil prices are kind of rising off the low. Dawn on Friday sent out a in-out spread for XLE, which if we look at XLE, it's the best performing sector today, in part because why? It's the most oversold. Its 3-week performance is the worst among all of them. And of course, oil prices have slumped recently. And could that help the October inflation number? Well, look, I mean, we were posting as high as 94, and look at how prices have come down generally. By the end of October, we did finish at around 82. So that may help the headline number. Of course, we're more focused on the core CPI number, which strips out food and energy. We've seen continued downward movement in oil. And as we look at the oil futures curve, /CL, you'll notice that the curve has flattened pretty significantly since, for example, the beginning of October and end of September. That orange line is October 1st. This is where we stand today, right? The price change as we go from one contract to the next is pretty minimal. The curve is pretty flat. We've taken off the table this implied shortage, and we're coming into something that's not normal, but is only slightly bullish. And what that means is transition can be painful as oil prices continue to fall. Now, again, what does this mean for the broader economy? It definitely means we're pricing in the potential for a recession going into next year, that demand should or will fall off. At least that's what the oil futures curve is currently pricing in. Right now, at this stage, we have very low supply relative to the 5-year range. And it's the fact that we've seen this backwardation come off, and we're seeing more of a flat structure here as we're going out several months, just shows that there's some concern over oil demand as we push forward in the coming months, which ultimately is recessionary. And so as we turn our attention back to inflation and bonds, What does this mean for bonds? Well, if inflation comes in hotter than expected, that puts pressure on the Fed to raise rates. I just don't think the Fed is likely to raise rates. We'll see how much the market buys into that, but it doesn't mean that this can't push to the higher end of its range. Sorry, we got froze there. Or we could push towards 5% again. We could very readily see a retest of that level if inflation comes in hotter. If we see that inflation is coming in more relaxed. I kind of feel like as we're looking at TNX, what is the neutral rate if the Fed is not expected to raise rates but aren't expected to cut rates? I certainly think 4.25% is an area where this could trade into. And so we might see a rally in Treasury prices fall in yield if inflation comes in less than expected, and we can find ourselves quickly back in this 4 to 4.25% range. But without an expectation that the Fed is going to cut rates, it's going to be very, very hard for it to get down here. The current Fed funds rate is 5.25% to 5.5%. And so again, can we really get down here to 3.5% if the Fed funds rate is sticky up here? So with U.S. debt being on negative watch from Moody's, this also creates kind of some levitation on yields and suppresses prices. So we may have a more difficult time getting down to this level unless we start to really price in the potential recession and the potential that the Fed is going to cut rates. Otherwise, again, with the negative watch news today, we might find ourselves just kind of hanging out up here and maybe pushing towards the high end if the inflation numbers come in hotter than expected. Maybe we're a little sticky and might move down slowly. So again, the scenario where we're down here is probably if the outlook is probably recessionary, where the Fed is going to cut rates. But I do think this is a neutral rate before today's news from Moody's about putting our debt on negative watch. And again, with the spending proposals coming up here again, there is going to be some gamesmanship, brinksmanship. I don't like that term, but the reality is there are those for fighting for their causes, the cause of spending or the cause of cutting spending. Both are running on those political aspects, those political points, and they're going to want to see some traction on that. We just had a speaker replaced as a result of the lack of seriousness on the debt side of things, and as a Republican kind of measure or proposal going into elections next year. So we'll see how that shakes out, but I definitely assume that we're probably not going to be unched by the end of the week if that's the case. If we look at skew, right, option volatility skew right now is on Friday it ticked higher to 139. I would expect it to probably higher when we get the end of day print for skew. The bottom line is that while we're seeing that the 3-month to 1-month VIX shows there's room for the market to rally here, it's probably going to take a drop in yield to help push that higher. We're still going to probably see the skew is going to remain elevated, which means that the downside risks remain as we move into the end of the year. So as we're looking at inflation, as we're talking about Treasury yields, what does that mean for gold? We're entering a seasonal period for gold going back to 2014, where typically gold rallies, bottoms in November, rallies in December into January, sometimes the middle part of January, sometimes bleeding into February. So I'm keen to watch what's happening right now to gold specifically. Again, CPI tomorrow. Bond yields will be impactful. So for example, gold likes falling Treasury yields as it's a negative yielding asset. So again, falling yields helps gold. And if we start to see some faltering in dollar prices, this is the dollar relative to a basket of other currencies. But if we see the dollar index start to decline, again, we might start to see a bottom in gold in the next few days. And we may have a chance of retesting our prior high or maybe more leading into the beginning of next year. So gold is an area to watch. And also we could continue to watch gold stocks, which started to see a little bit of traction on the bullish side of things on the 3rd of November. That has faded as the dollar has strengthened in real terms and gold prices have faltered over the last couple of weeks here. But again, seasonally, as we enter December and January, normally gold has bottoms, and it's done this for almost the last 10 years in this late stage. And this is largely precipitated by stagflationary pressure. So again, if we see that the Fed is maybe more inclined to cut rates, inflation is easing just a little bit, we see the Fed's going to potentially more cut rates, and we see a slackening economy, but we still have inflation issues. This is the stagflation result that generally is pretty bullish for gold. It's what led gold to see a massive rally here back in October. So again, we may have stole some of the thunder going into the new year, but I certainly expect we might see a rally in gold to 185, possibly 190, just on that seasonal trade based on the economic story weakening, maybe spending for the holiday season faltering compared to past years. I mean, 20, 21, even 22 were banner years in terms of spending. We may revert to 2018-19 levels, which means spending is going to correct, which means you might want to wait to buy your goods, your gifts until maybe after Christmas this year. But the point is, we could see some softening on tailing revenue expectations, which has been kind of a sore spot for stocks this earnings season. We have the beat rate on revenues has not been as high as recent past, being below 60%. Earnings has come out better, but all that means is that margins are improving rather than seeing real top line growth pushing things. So we may see this kind of malaise carry us through, which is going to be part of what help make gold sparkle going into the end of this year, beginning next year. So a lot of stuff to watch out for this week. Again, probably remain light until we get kind of a direction here, because right now, ARKK is a great example of just the overall indecision. ARKK is an ETF. Top holdings, stocks like Roku, stocks like Tesla, okay, stocks like Coin and others. We may find out soon about a Bitcoin ETF or cryptocurrency ETFs, spot ETFs. But the point is this, is that as we look at ARKK, today's trade is pretty mixed. So for example, on ARKK earlier today, we had a November expiration trading here at the 39.50 strike right about here. Again, some bearish trade. And then on the flip side, we're seeing bullish trade out for the, NOV 41 calls out here. So again, does this outweigh that? Sure. The volume is certainly bigger. But the point is, over the last couple of weeks, little week plus, what we've seen is that, look, there's been a lot of bullish and bearish trade on ARKK. And this goes back to what we saw on Friday. I walked through this during my session on Friday with our members. We talked about, look, there was a lot of rolling on Friday, which basically just calls into question, what is the next stage of the market? Are we going to go higher or are we going to go lower? And today's very tight range and unchanged status from Friday's close or close to it just shows we're just waiting to see what this week's going to deliver. So be careful to load up early. Look for that breakout to help provide confirmation. There's a significant print here, 436.50, that could be key. If we start to break that level, we may get some downside traction. Otherwise, we may roll to the next significant print at around 447.18, possibly up as high as 450. So again, we have a lot of potential here, but the canary in the bond mine is TNX. So if yields rise, watch out below in the market. If yields fall and we start to approach what I expect to be kind of a neutral rate here, this could help uplift things, right? IYR today. This is an ETF I've been bearish on for the last week. This could very readily see some buying activity if yields start to fall. Because again, you look at where XLRE is the worst performer, second to the worst performer today, along with utilities. But these are areas that could really flip around if yields begin to fall and we take on more of a defensive posture. A stock today, also a defensive postured stock, is Kraft Heinz Company, right? So we had this run here. We had the flag formation. This was on the earnings. There have been some negative earnings downgrades for it. So this is a cautionary note. Today did not exactly break out on high volume. We approached to be kind of average volume, but we could see it. This could be the breakout today. And we could look at about a 34.50 to possibly maybe 35.50 here as an upside target. Notice the 61% retracement, fib retracement is around 35. So that is a pretty reasonable area to expect Kraft Heinz to go. Now, the good thing about it, the pricing of these options, well, let's look at the activity. This is a Nova expiration, 19,000 contracts traded at the 33.5, mostly bought. But we put in perspective here, what could you trade? Notice that on the 22 December, 39 days left, we're seeing rising volatility. You could buy a 34 and sell a 36 here for about 30 cents. I understand that's pretty cheap. Maybe you don't sell the 36. Maybe you go out to January, 67 days left, and just buy a 35 or a 32.50. Okay, this would be reasonable. 35 strike. Again, we're expecting it to get to 35, maybe 35 and a half. You could look at going maybe in the money here at 32.50. But the point is, we're looking at decent upside, and the skew is favorable for positioning yourself in a spread. The issue is just this is a low price stock, low volatility stock. There's just not a lot to sell here. So you could even buy, again, like a 22 East or 29 East, go 34 strike here. We're 75 cents out of the money. Cost you between 30 and 40 cents, or go one strike in the money to 8.33. And that would allow you to play the upside here if we swing towards 35, maybe 36. Okay. So again, a defensive stock that's seeing some bullishness today. Procter & Gamble similarly breaking out today. So again, we may see more rotation towards staples. It's just hard to get a bullish trade on a staples and do a vertical because of the skew. The falling call volatility on these out of the money options make these spreads a little bit more expensive because you're buying here and selling out here. But again, it's still reasonable to look at the upside in the near term, 70, maybe rising as high as 71 here in the coming weeks. Another stock here today, EQT. So, I like to look at oil. Oil makes sense. Natural gas does not. Okay. Just so you know, but EQT is a natural gas production company. It is at support down here. It was higher today. Again, energy being a leader. And as we look at /NG, we're looking at natural gas. Natural gas got a nice boost today. So if we're looking at maybe weather, other things, maybe there's some near-term positivity to natural gas towards the 350 level, which may help lift stocks, especially if the market does rally with it, to 42, possibly 44 on EQT. And again, the option activity today in EQT is why we're looking at it, is a December expiration out of the money here at the 43 strike. So looking at near-term potential, 243. And again, the skew is a little bit unfavorable out here, but not terrible. If you want to do like an upside spread, like buy a 41 and sell a 43, it costs you about 61 cents or 62 cents. All right, so EQT, we're looking for a little bit of a bullish swing in energy, and specifically in this case, natural gas. But what about banks? So we look at KRE. If bonds were to sell off, we had the pullback here after the nice bounce. We're kind of sitting in the middle of this range from low to high. So we'll measure low to high here. We're at about the 50% retracement. We're consolidating over the last couple of days. What if we break the low today, which is about 40.76? We could readily see this pull back to around that 38 level again. And that's kind of what the trade in today happened. And as we look at TNX, if we see selling in treasuries, these unrealized losses in regional banks are pretty dang high and would only create added stress if yields were to run towards 5% and we see further selling in treasuries. But KRE today, the trade was bearish, maybe in anticipation of some of the movement this week. But if we look at KRE, this is an 8 December expiration. We're looking at 10,000 contracts out at the $40 strike price and 36. This is a downside long put vertical spread, buying the lower vol, selling the high vol. So it's a pretty cheap spread going for about 80 cents, 79 cents. And again, $36 has us retesting our lows from May. So it's a relatively cheap shot, low price, high reward, low risk, low probability, but is playing that downside potential here, playing in the direction of the skew to help it in lieu of a sell-off in the coming weeks in KRE. We'll wrap this thing up with another regional bank. That's an ETF. But KeyBank is a regional bank itself, right? It's part of that bigger index and part of the holdings within KRE. On Key today, it's a November expiration, relatively short term, 3,900 contracts, mostly bought at 1050. And again, we look at KeyBank here, 1050 has about the middle of the range between where we're at now and support. But we could readily see this pull back to around 980, maybe as low as 950. So if you're constructing a trade on this, it's relatively easy on the downside. You look at 10, you've got 9. Well, what about the weeklies? Does this offer more strike prices? It does. You'll see we're at 1085 right now. You could buy at 1050 and sell at 950. May cost you around 30 cents. You're buying the 45 vol, selling the 50. It gives you a little bit of an edge. We're looking at $10 being the lower expectation, but 950, there is premium to sell there that reduces your cost materially. If we roll back to 950, that could be a significant win on a pullback here. So again, we're just seeing a muted pullback. Volume's been relatively light, but if things start to pick up on the downside, these might be your opportunities. We're looking at bullishness on KHC, EQT. We're looking at the downside here in Carry and Key, and also XLK. So technology's made a nice run here. What's the prospect of a near-term pullback, maybe with testing 171? If we look at XLK, this is a 24 nova expiration, so next week. And if we look at the volume here, it's on the 175 strike, mostly bought. Again, could be hedging, but it doesn't matter. We're looking at the downside expectation near term to 175. That's not much of a pullback, right? And so you can construct a spread pretty easily. Let's say for the December expiration, and you start to look around at the money, 178. What if you got a 178 and sold a 176, cost you about 75 cents? And if this thing were to pull back to 170 or even 175, you have the potential to get out of that relatively quickly. Well, folks, got to wrap it up there. We'll catch you back in the video next week. Have a great one.